Good morning. This is Bruce Fleet with Fleet Capital Management. It is Saturday morning, November 12th, 8:34 a.m. out on the Pacific, rainy right now, Pacific coast. And I wanted to give you an update on what's going on in the market. It's been quite interesting. It's been extremely frustrating. There have been some ups and downs, but I wanted to give you some visual reporting just so you can see exactly what I'm looking at as I make decisions. And decisions are certainly easy in a trending market. They are very, very difficult in a whipsawing or sideways market. So let me just show you a couple of things. I want to start with what the market has been looking like lately. This is the S&P 500. I'm on a daily chart. And I've created some boxes here for you to focus on. A couple of things, and then this line is also the S&P 500. So this is the daily price bars. This is a line bar, a line representation, which will show up later in this webinar. That's why I point that out. This was a year ago, August, that massive drop that we had that really shook everyone to its core. This is pretty much days after we started the new trading program, and there were some indications happening right in here that led me to go completely to cash, and therefore we missed this. We saved ourselves an enormous percent drop, and then the market started to come back up, and we started to buy in here, and then boom, it just slapped right back down. This is called a double bottom or a W bottom. Market starts to come back up, we start to buy back into stocks, and then boom, another drop, we get whipsawed out. That almost looks like another double bottom. As the market's going up, remember, we don't know what's going to happen to the right of where my pointer is yet because we're not there yet, but we're seeing this strength. We're starting to buy back stocks, and then this is the beginning of the year. We had another massive drop, another W bottom or double bottom, if you will. So what I'm trying to show you is every time over the last year we started to buy back in because this looks like the beginning of an uptrend, doesn't it? It sure does to me. So we want to be buying stocks so we can profit on that, but then we kept getting whipsawed out and either making a few dollars or more likely losing a few dollars. Then now we're in this period coming February, March, April. Market's looking really healthy in here. And I'll show you what I mean by the words healthy in just a minute. And we're buying stocks, we're loading up our portfolio, and it starts to get whipsaw again. This here is Brexit. When the market drops this precipitously, it stops us out of our stocks, whether we're in a profit or a loss. There are stop mechanisms in place, and this is what I mean by whipsaw. We're buying, we're adding, we're building our portfolio, and boom, we get whipsawed out. And by the way, this is all abnormal. And then we go into present day, and here is prior to the election. And then, of course, to everyone's amazement is election day. The market rallies back up, and it's starting to fall off just a little bit again. But a couple of things I want you to notice here. Look at all of the whipsaw. If you watched the video I sent you about a week ago from Bob Dole is one of the top money managers in the nation, if not the world. And he even said the last 18 months has been the most frustrating of his career, and I would echo that. I've been doing this over 30 years. It's been the most frustrating of my career as well. Aside from the whipsaws, look at the value of the market. The market on that particular day was 2132, and that was a year and a half ago, I guess, and we're a little higher than that now, but not much. I mean, this means sideways, and this is whipsaw. So I just wanted to show you that. Let me go to another chart. This is another system I use. What is a trending market, whether it's an uptrend or a downtrend, but we're going to focus on uptrend. What is a trending market in technical terms? Well, if you look back here, this green line, this is the 20-day moving average of prices. The blue is the 50-day moving average of prices. The red is the 200-day. The reason I use the word day is because we're looking at a daily chart. If this was a week, it would be 20-week moving average. So we're looking at days right now. When I say a bull market or a bull trending market, the 20 is clearly above the 50 is clearly above the 200. That's what we call a bullish trending setup. Okay? And what we do is we believe this until it tells us we're wrong. That's how technical analysis works. There are some other things I won't spend a lot of time on, but this was very bullish. This is the MACD, which is the Moving Average Convergence Divergence Indicator. Again, I won't go into it, but this is a bullish setup. This is the PMO, Price Momentum Oscillator. This is a bullish setup. But let's just focus on these averages. We want to be buying in here because this is a bullish setup. And see how the 20-day dipped back down but didn't touch, because we had a few bad days in there. It didn't touch the blue. That's still a bullish setup, but it's with caution. It means under pressure. Okay, you can see the same thing happened here. It didn't cross below, but then here it's starting to cross below. The 20-day is below the 50, and look at what happened. And we've had a lot of difficulty in the market in here. And then after post-election, we've got 3 days of a pretty strong rally, but it looks like it's starting to fade. So when I say a bull market, this configuration is what I mean. And if you look at today, because as chartists, we say we live on the right edge of the chart. This is all we know. We don't know what the next day will hold, which is what makes this so interesting and so difficult. But what I do know is the 20-day has gained strength because of the last 3 or 4 days, but it has not crossed above the blue line, the 50-day moving average. So it's not technically an uptrend yet. This could just be a whipsaw. We've seen that many times in the past. So a full technical trend is 20 above the 50, 50 above the 200, and then there's some things with volume and some other indicators. Another thing that I look at looking for trend is Investors Business Daily does a market trend analysis every day. Theirs is different. It's not based on moving averages. It's based on price and volume, period. So if the price goes down significantly, let's say 1%, and the volume on that day is greater than the day before, that's bad. That's called a distribution day. And the market will only allow so many distribution days before it changes its trend, as per Investors Business Daily. Just the other day, it snapped back into what they call a confirmed uptrend. It had been for a few weeks market under pressure. Which is not a sell. It just means it's a market under pressure. The next level would be confirmed downtrend. Then we'll look for down. So to make a long story short, I'm looking for this to be in a confirmed uptrend and the 20 to be clearly above the 50. Then to me, that's a confirmed uptrend. So I'm using 2 different sources, and we do the same thing on the downtrend. Someone asked me the other day, we're in this difficult market, why aren't you shorting or using inverse securities? Great question. Because the trend is not saying that yet. And if I had been using inverse securities or shorting, we would have gotten killed. I mean killed with this snapback. So if the 50-day crosses below the 200-day, and then for even more confirmation, if the 20-day is below the 50-day, then we're in a confirmed downtrend. That is the only time I'll use inverse securities, and it's the right time to use inverse securities. So on the first step of this video, and this one may end up being a little longer than normal, I apologize, but there's a lot of information I want to show you, is we have to make decisions based on the right edge of the chart. We don't have anything. We all, another adage we use is look left to learn, but we live here. If anyone can tell me exactly what the market's going to do on Monday when it opens, I would like to hire you for an untold sum of money, because no one knows. We can only use analysis to help us get our probabilities in our favor. And when a market is whipsawing, like I showed you before, when a market just is going up and down and up and down and side to side, it's hard to put things into your favor. So that's the first step of something that I wanted to show you. The second thing I want to talk about, and I don't have a chart for, is the other day I sent out a market update and I said, this is something that I had never seen before. The Dow Jones was up about 180 points. And the NASDAQ, let's say it was up 1%, and the NASDAQ was down 1%. So I received a couple of emails saying, how could the market go up and my account went down on that day? Another excellent question. The reality is the style of the stocks that we buy tend to be more in the NASDAQ because they're growth, that's the growth index, than in the Dow. So just because the Dow only represents 30 stocks, that's it. Out of 8,000 companies, it's 30. So if the Dow is up and the rest of the market is down, first of all, that's very shaky from technical analysis. It means there's no cohesiveness in all of the markets. The Dow could be up 1% or 2%, but if the NASDAQ was down 1% or 2%, your account's going to go down. Because the preponderance of the securities we buy are NASDAQ and Russell related. Some are Dow related, but not most. Okay, I hope that makes sense and answers that question. And again, all of what I'm showing you is really coming from emails and questions that I have received. Now, let's go into another thing. Let's talk about earnings for a second. I'm going to change this to Facebook, which we owned, and I'm going to take us to, I'm changing the date here to 11/2. Okay, so on 11/2, here's Facebook. We're in Facebook. We're making a little bit of money, not a lot, and earnings are coming up on the 3rd. Right now, we're on 11/2, okay? And earnings are coming up the next day or after the close, but that's, don't worry about that. So here's what I'm seeing, because I live here. I live on the right side of the chart. And let me get an annotation tool up for a second. I'm going to do draw. And I'll just do this. So bear with me a second. So this is where I'm living. And disregard the S&P right there. I'm seeing 2 days where Facebook is falling significantly. And not only is it falling significantly, it's falling significantly and it has huge volume. This is the volume for the day. That line is a moving average line of the volume. I believe it's 50-day moving average. So if, this is below average, this is a hair above average, this is huge, huge volume. So I'm seeing the market drop on Facebook and I'm seeing huge volume, which generally means institutions are selling their positions. Retail investors can't generate this much volume. Institutional investors create volume. So I've got to make a decision. My decision is, do I hold Facebook into earnings or do I sell Facebook into earnings? And that is a question that we have to deal with all the time. Well, I decided to sell Facebook. And now let's go to the 3rd. Now we're in the 3rd. And we sold up here, and look at what happened. Earnings came out, and the stock dropped precipitously on big volume. Let's go to the next day. Okay, the stock came back up a little bit. The next day, a little bit more, and then it's starting to drop again. And now it continued. Wow, now it really dropped on the 10th, and on the 11th, it dropped even more. Okay, so we sold up here. Earnings came in. And by the way, earnings came in very, very strong. They weren't bad earnings. It's just in earnings season, the reason earnings season is so crazy is because analysts out there have their opinion of what Facebook earnings should be. And then if the earnings come in really strong, but it's a penny or two below what the analyst thought, the expectation, the stock price drops. So let's go back to Facebook for a second. I sell out of here because of some things I'm seeing on the chart. Earnings come out, the stock crashes. Guess who's a hero? I'm a hero. Now, that changes really fast. So let's go to another stock that we own. And I'm going to go back to 11/9. So we're in NetEase, great company, and something is starting to happen. Oh, excuse me. We sold on 9/26. So let me go back. Let's see what date this is. I'm not seeing it. We sold back in here. The stock was going up and it started to fall off and we got stopped out, and then the stock continued to rise. Bruce looks like an idiot again, but there were reasons that we sold. And then if I go to the 9th, it's coming back up, but earnings are getting ready to come. So let's say we still held the stock. What should we have done? Looks like the market's going up. Earnings came out, fantastic earnings. Look what happened to the price of the stock. It collapsed. way below where we sold it on 9/26. So Bruce was an idiot for a few minutes, and boom, now he's a genius again. For those of you who are following the price action on each day, then it snapped back up a little bit. So far we're doing okay. Now let's look at Edwards Lifesciences. You're going to see a trend here in just a second, and I'm going to go back to 1025. Okay, here's 1025. This is the day before earnings. Every analyst on the street was saying that earnings for Edwards are going to go through the roof, absolutely through the roof. But I was seeing some price decline, and I was seeing some volume spike, which is not always bad, but to me it's generally bad. But I decided, every analyst across the world was saying that Edwards was on a tear and their earnings were going to be fantastic. So in that case, I decided to hold it. Let's go and see what happened. See this drop? This is when earnings came out. It dropped significantly, dramatically. And it's been, I'm going to keep clicking, it's been dropping and bouncing up and kind of hanging out. And now it looks like it's starting to come back up. Let's see what day we're on. We're on the 10th. We're on the 11th. Okay, now it looks like the stock's starting to come back up. So I decided, one of the reasons I decided to hold this, bear with me a second, let me get rid of some of this stuff. I'm almost there, hang on. Okay, it's not showing it. I had seen those types of drops before with Edwards in the past on earnings days, and maybe it was on the weekly chart. Let me go back to the weekly chart. Yeah, here it is. So you see that big drop, and that came in earnings. See that big drop, and that came in earnings, but then it just rallied right back. So I decided to hold, and I decided to hold. It's never haphazard. It's because of reasons. Look left to learn at how a stock has reacted in its past. I decided to hold it. Well, now, and that hurt us. That hurt our performance significantly. But it looks like it's starting to trend back up. But again, should I have held it or should I have sold it? Well, you be the judge. The most recent one, and the last one I'm going to go over with you, is NVIDIA. NVIDIA is an amazing company. I'm going to go back to, let's see, here's the 9th. So we had a really, really strong gain in NVIDIA, but it's already up 112% from way back when it was initially called. We weren't in the stock back here. We got in a little bit later, which means it's really gone on a tear. And usually stocks will then sag back. It went on a tear here, and then it comes back for 6 months. So it looked like this could drop again, and we're on a daily chart. So I had to make a decision, excuse me, what to do. And now let me go to the 10th. They were reporting on the 11th. What am I seeing? I'm seeing a big drop with a huge amount of volume. You see that? Let me get my little drawer machine here. So here's what I'm looking at. I'm looking at a big drop, and I'm looking at big volume, institutional level of volume. Have we seen this before? Yes. Did it serve us well to get out of the way? Yes. Were we right to sell Facebook because we saw this? Yes. Were we right to sell NetEase because we saw this? Yes. Should we have sold Edwards because we saw this? Yes, but we didn't, and it hurt us. So with all of the volatility in the market and everything that's been going on lately, which has been craziness, I decided to sell it because let's just say, for example, that it's 50-50, that the stock's going to go up or down after earnings. After the loss we took with Edwards, and based on the track record of some of these stellar companies, Facebook, NetEase, Edwards, I just felt that the 50% chance that this stock could drop significantly, 15-20%, was not worth it. So I sold. And let's see if I was right or wrong. Man, was I wrong. Because the next day, the stock price jumped like 20%, 24%, whatever it was. Do I wish we were still in the stock? Of course I do. But we didn't have this knowledge yet. I had to make a decision based on past performance, and I made the decision. Does that mean NVIDIA is not a great, it's a great stock. It's a phenomenal stock, as this shows. Will we get back in it? Yes. We won't buy anywhere near these levels. Look how high the stock price is above the 20-day moving average. There's something called reversion to the mean, which some of you are very aware of. Things get extended from the 20-day moving average, they come back. They revert to the average. They get extended, they come back. That happens all the time, 99% of the time. It got extended, it came back. It's hugely extended. You know, a month from now, 2 months from now, 6 months from now, I don't know when it is because I'm watching it every day. If this comes back, reverts to the mean, we'll probably buy the stock again. But this is why I sold, because this is a 50% possibility. But if you picture a red line going down here, that was a 50% possibility. And I didn't feel on your behalf that we should take that risk. That's why I made the change. Now, with that said, let me stay with earnings and bear with me. This is all going to start to come together for you in a minute. Zacks Investment Management out of Chicago is one of the leading investment research firms in the world. And their focus is earnings. That's almost all they do is earnings research. They really don't do technical analysis. They do earnings. I've been arguing with Zacks for years, and not just me, lots of people saying, you guys are the earnings king. There's got to be a way that you can help us increase our probabilities, whether we should hold on to a stock going into earnings come out every quarter, or should we sell a stock before earnings? Well, they've been working really, really, really hard and testing and testing and testing to figure that out. And they've come up with a new plan, a new program based on earnings estimates. That's all you have. And it's called ESP, Earnings Surprise, let's see, I forget what they call it, Earnings Surprise Report or something like that. Here it is, Expected Surprise Prediction. Sorry about that, Expected Surprise Prediction. And they've come out with a methodology that I'm working with them right now in testing to where they will rate, based on metrics, the possibility of a stock going up when earnings are reported or going down when earnings are reported. This is a science, but it is far from 100% science. So here's NVIDIA Corp. And the number I want you to think of is 0, 1%, 2%, 3%. If a stock is rated 1 or 2 from Zacks, and these ratings are based only on earnings, okay? And if the ESP, the earnings surprise predictor, is above 2%, in this case it's 3.5%, then there's a 70% likelihood the stock will rise after the earnings announcement. It's not 100%, it's not 90%, it's not 80%, it's 70%. But based on this, which we didn't have the other day, by the way, for NVIDIA, based on this, we should have held NVIDIA. What I've asked Zacks, the people that have designed this system to do, and I'm going to talk to them Monday or Tuesday next week, is tell me what these numbers were for Facebook, NetEase, Edwards, and we're going to take a look at that. And if those were predictive 70% of the time, then next quarter, I'm going to start using these. So if I was using it this time, we would have stayed in NVIDIA and taken that chance. Because a 70-30 split, a 70% that it's going to rise, it is worth taking. There are no 100% in the stock market, unfortunately. So we've been whipped around a little bit in earnings and in the market. I mean, it's just been a perfect storm of frustration. You feel it. Believe me, I feel it. But we're trying to work it out. So what do we know so far? We know we're buying the right stocks because these stocks tend to go up and then everything goes down when it gets whipsawed. But 9 out of 10 times when we buy a stock, it's going up. It's just we've been in a trendless market. So we know that our stock analysis for purchase is doing a really good job, and I'll show you some of that. What we also know is that it's been a difficult market and earnings have been tough, and we're trying to fix the earnings piece of it. And with Zacks' help, we may have fixed that earnings piece. So right the day after I sold NVIDIA, now that's out of our portfolio, I went out and purchased Microchip Tech, which is very similar, but not exactly the same, but same industry, everything else. And I went out and bought this stock. So this is what the analysis looked like. There's actually more to it. But this dashed line and the bottom of that blue box is called a pivot point. That is the absolute best place to buy a stock. Whenever I can, we buy at the pivot. And we did. We bought it right at the pivot. When I looked at my analysis, here's my analysis. I want earnings per share rating greater or equal to 80. Relative strength. This is a list of what I've created in my FCM screen in working with William O'Neill. And this company hit 100% on this checklist. Very rare that they do hit 100%, but it hit 100%. It's also owned by a lot of really great mutual fund companies. It's doing really well. Its industry rank is high. These are things I show you. For earnings, it's number 2 out of 40 in its segment. Number 1, I believe, was NVIDIA. So we're looking at a lot of analysis here. I was also looking at analysis on another part. Stay with me a second. NVDA. Okay. Here was that pop from earnings. But, I'm sorry, I got the wrong one in here. Let me do CHP. This is the stock we just bought. So I was looking at the stock here. We've got a bullish setup in our moving averages. We're above the 50 point on the relative strength. MACD is pointing up. Everything's pointing up that I told you looks good. So we decided to buy this stock, and we're already up at 0.5%, but we will ride that, and hopefully the market will turn into a trend. And if it turns into a trend, we're buying phenomenal stocks that are almost always outperforming the market in an up market. And we buy it, and then we use stop management. And now, when they just reported earnings, I waited until after their earnings announcement. 3 months from now, 13 weeks from now, we will decide, depending on how the stock does for us, of course, if we want to hold it into earnings. And we will use some of these new Zacks features to decide if we're going to take that risk, because it's a risk to hold into earnings. So we're buying the right stocks. We have a horrible market for the last 18 months. We're getting whipsawed. We're going sideways. It's knocking out of our stocks. We had all kinds of weird earnings surprises. Weird meaning this is just not typical. This is not a normal environment over my last 30 years. Bob Dole said this is not normal. This has been very strange, very frustrating market. So it has for everyone. But I just want you to know decisions are not made haphazardly. I look at everything that has to do with fundamental analysis. I look at everything that has to do with technical analysis on multiple different companies and screens. And I hate to say we're just going to have to be patient, but we've got to find a trend. Is the market in a new trend? Well, we'll end where we began. I'll take the S&P. No, not yet. This is just a 50 and a 200-day. If I were to overlay the 20-day, you'll see the 20 is below the 50, like we looked at on another chart, on this chart over here. Let me go back to the S&P so you can see that. We're not there yet, but if this green line crosses above the blue, meaning 20-day is better than the 50-day, which is better than the 200-day, and IBD has a confirmed uptrend, which that's probably going to remain unless something bad happens next week, we're going to start loading up our portfolio. And we get that signal from the markets, we'll load up our portfolio, and if that trend stays in place for 6 months, we're going to make boatloads of money because we're buying the right stocks at the right point. But the market has to help us. And if the market doesn't help us, it makes it very difficult. So I wanted to give you that update. I hope that wasn't too long. I hope it wasn't too complex. You can always watch the video again. As always, feel free to share this video. There's nothing in here that is proprietary. Well, it is proprietary, but nothing in here that's a secret. I should have said at the outset of the video, if you're watching this and you are not a client of this firm of FCM, please do not take any of these stock discussions as recommendations. Even the most recent stock that we just bought, please don't take that as a recommendation. I don't know you, you don't know me, and this video is for educational purposes. It's not to tell you what to buy or what to sell. So, difficult time. We have the election behind us, thank goodness. That was a miserable 18 months for all of us watching that garbage. We have a new president. We wish the new president every success in the world. because that's how our democracy works. It's just as simple as that. And hopefully this market has received this jolt from this unexpected outcome, and jolts sometimes start new trends, whether it's up or down. Those are easy to make money with. We just got to get out of this sideways stuff. So that's the story for today. I really do hope this was worth your time, and I hope that that it was enjoyable and that you learned something. And I'll talk to you soon. Just email me with any questions. Bye-bye.